Hi, I'm Chris Hempstead. Welcome to On the Vine podcast with Mirae Asset Securities USA. Today, I'm privileged and excited to have Dan Dolan from the Select Sector SPDRs visiting with us. He made quite a trip out to us all the way from
Garden City, New York, Long Island Railroad.
All right.
All of 35 minutes. Yeah.
We were chatting earlier about fun times that we have every now and then out in Garden City. We have a little fun dinner that we do out there. I don't get to Long Island often, but for this one, it's a good one.
It's an old ETF traders day, appreciation day at night at Jimmy Hayes Restaurant, and it's always a good time.
Yeah, Jimmy Hayes, one of the old timers in ETFs, actually used to work at this restaurant. He's now a very senior, prominent ETF trader and manager. But
many waiters turned into ETF traders over the years.
Exactly. I was a dishwasher, not a waiter, so not a Jimmy Hayes, but a similar type place up on the Cape. But thanks, Dan, for coming in. There's no doubt that the Select Sector SPDRs are a household name and an institutional name across hedge funds and insurance companies and individuals when they want quick hitting exposure to industrials or energy or whatever it might be. It's the first place most people look. Can you tell us a little bit about the history of where these came from, how they came to be? Not looking to age you.
You are aging me here. So I started working on Sector SPDRs 27 years ago. So in 1997, I was working at Merrill Lynch, and I was the director of equity marketing at Merrill Lynch. And we had a terrific strategist, Chuck Clow, that would talk to all the Merrill Lynch brokers and tell them what sectors he liked. And he built model portfolios before his time based on investor profiles. And the thought was to take the S&P 500 and to carve it into pieces so we could fit Chuck Clow's model portfolio. So if we had a capital preservation investor, we'd overweight utilities and energies and underweight technology. So the idea was to take the pieces and carve it up, deliver to the advisors, and then actually the world at that point, S&P 500 in pieces.
Were you doing that in SMAs before?
Oh no, it was before SMAs. So this was 1998 when we launched. We were the 21st to the 29th ETFs in existence, right? So Sector SPDRs were really the first ones to take a non-broad-based index. So you've been around a long time. You remember the country baskets, or the caskets as we refer to them after they closed. And then the webs, that were really the only things that were out there. The big SPDR, the mid-cap SPDR, caskets and webs were the only things out there when we launched Sector SPDRs in December of 98. There really weren't SMAs that people were doing at the time. So we were doing something through a portfolio entry system where we could weight the 9 sectors. Advisors could buy them in the different weightings that were appropriate for that type of a profile, and they owned all 9 of them.
So I remember them intimately because even though I had dabbled as a clerk in the country webs and things like that, I never really truly dug in until around 99 when the QQQs were set to launch, and the firm that had brought me in to help run the QQQs was already the specialist in some of the sector SPDRs, and so I remember my deep dive into pricing and being able to arb ETFs started with some of the sector SPDRs.
Well, some of the original guys there really do not get the credit for the success of the ETF industry, but guys like Gary Gastineau, who were early, and Gary Eisenreich, particularly on the trading side, that were trading this and developing markets and getting liquidity going on SPY, and then evolving into sectors, and then the Qs came in March of 1999.
Yeah, I clerked for Gary Eisenreich, and I still see him periodically. We bump into each other at an industry event here or there, and
he has a lot to do with the success of the ETF industry.
Absolutely,
no question.
But it's been a long road, and one that I don't think anyone regrets having traveled. ETFs now in the U.S. alone are over $9 trillion, I think, is something. It's incredible to think that it's gotten that big, and we're probably still in the early stages. So we've definitely paved quite a success story behind it on the heels of the Select Sector SPDRs, and a lot has come through. But they stand the test of time. They come in handy over and over and over again. Now, as an ETF, if you want to say ETF nerd or an ETF, insider, it's easy for someone like me to say, okay, there's 3,000 ETFs available, plus 3,000 plus, and maybe this one's not right for you. Maybe we can get something more customized. But no matter which way you slice it, people want quick exposure, or they want the right exposure to industrials. They know they can go to XLI. right?
Yeah, I think, when you talk about 3,000 plus products, the really good ones are the ones that have institutional and individual private client interest, right? So that institutional demand, the institutional trading keeps those spreads tight. The private client investor tends to hold it a little bit. So there aren't a lot of those 3,000 that combine the volume of institutional demand with the stickiness of private client, buying and holding type of stuff.
Is it partially too because some of the larger institutional clients have a mandate to track perhaps the S&P 500
Sure.
and the sectors? They can't afford to deviate too much from that, so they have to stick to the
Absolutely. I
core.
mean, we have a big advantage of being the unique provider of sectors in dividing the S&P 500. So we have the sole ability to divide the S&P 500 into pieces. There are other sector products out there, but they're not the components of the S&P 500. So our ability to do that gives investors, they can customize the S&P 500 to their liking. But even if you own it in pieces and do it for tax reasons or whatever you want to do, you're going to track real tight to that. So because of so many factors, the liquidity provided, we trade 150 to 200 million shares a day. Of this, when I started working, the entire volume of the New York Stock Exchange was 100 million shares.
Yeah.
We trade 150 to 200 million sector spiders every single day.
Yeah, and there's no issues with liquidity at all.
No.
Well, so
Widespread.
let me back it up 1 second. You said we are responsible for these sector spiders and select sector spiders.
Right.
And I've asked you this over the years many times to sort of help me understand the breakdown of who the we is. So are you State Street? Are you Alps SS&C? Are you Select Sector Spiders? Little inside baseball. I know it's more of a who are we talking to, and is it all the same company? Is it all the same brand?
It is a little complicated, right? But it starts to where it started at Merrill Lynch in 1998, and at the time we partnered with State Street, we partnered with the American Stock Exchange and S&P, right? State Street has since evolved and launched 130 other spiders.
Away from you.
They manage sector spiders. So State Street's the manager of sector spiders. The nuance here is that Alps is the distributor of sector spiders. So just the 11 pieces of the S&P 500, XLK, XLE, the XLs basically, that we are the distributor of the 11 sector spiders. So the sales, marketing, advertising, website, it's all dedicated 100% to driving the assets of sector spiders. State Street is a huge help, right? And they do a great job as well, but they do, sectors, and then they also do the 130, 140 other spider products that came after.
So you mentioned advertising. I got a funny story that I'll never, I don't know, maybe I'm building more into it than it actually was, but I love to go out and visit some of our clients and colleagues out in Denver, and Alps SS&C is based in Denver, right? So there was a massive conference at the Denver Convention Center by one of the largest wires in the world, and I think I remember asking either Dan or Terry, Dan's partner, Terry Deegan, what their presence was going to be inside the conference. If I remember correctly, it was like minimal or nothing, and we don't need to. And I kind of scratched my head, and I think at the time this particular firm was launching their own suite of ETFs, and I couldn't help but notice, though, around the convention center, every single city bus was wrapped in a select sector spider ticker. So you'd see them just going by all day long. And meanwhile, everyone that was attending this massive convention, 10,000 people.
Well, you're referring to the Schwab convention,
yes.
Which attracts thousands of advisors, right? That is our audience, right? So rather than pay Schwab, I think you have choices on how you want to reach people, so that was one option that most people don't go for, but we tried to do it. We were at the conference though too, so we had a booth handing out some tchotchkes and stuff, but we tried to get them to and from getting there and back.
Buses was gold. I mean, that was
We've done some interesting. When we first started, I mentioned Gary Gastineau before. Do you remember the old the trucks that would drive around New York City, the billboard trucks?
Yeah.
That was our first advertisement. So Gary and I were like in front of the American Stock Exchange with a billboard truck of the Sector Spiders serviced all 9 boroughs of New York City. It was awful.
I never got those trucks. I always think, wow, that seems like a lot, So is that a tough job, managing that, the advertising?
It's a fun job.
It's
a fun job. I mean, the primary audience for us is the financial professional, right? So we go, and the institutional investor is one, and then the core, the financial advisor, the independent advisor, the RIA. How do we reach that person? So, like every other ETF, right? That's where you want to reach, and if you get, to them, you get to their book a little bit. And we try to make sure the product's the best it possibly can be, but the advertising, just to stay relevant in their minds.
In that effort, does a select sector spider, so it's a total of 11 products now? 11 products since the addition of was it real estate?
Communication services and REITs.
Yeah, okay,
Right.
so there's been a little bit of a change, but not a material change. It started with 9, went to 11, that's it. Do you have your own dedicated wholesalers? Do you share wholesalers with State Street or others?
No,
or
we have a separate team of about 15 people that cover institutional and financial professionals. We have a separate advertising effort, separate website, and the website's covered at State Street as well. So we kind of go in dual places there. And obviously State Street helps on the sales effort as well. But we have a separate team that just drives Sector Spider assets.
And is this year, what's the feedback? We're heading into May. Just so everyone knows, I'm not sure when you're going to see this podcast, but we're heading into May. It's the very end of April right now. It's an election year. It's expected to be a globally contested race. There's a lot at stake. There's 40 elections in the world happening this year in some of the major countries. 50% of global GDP, I think, is having elections. I would imagine that from policy all the way down to specific company, perhaps. We're all looking at this AI stuff with TikTok and ByteDance and things like that. There's just so much at stake, good or bad. I would imagine your wholesalers are chomping at the bit to get in front of people and tell the story of why this year, among other years, might be a good year to take a quick look at the sector exposure.
Our basic positioning is 2 ways. One is as a stock substitute, right? So why continue to take individual stock risk when you can buy a very liquid basket to gain similar exposure with much less single stock risk, right? So something like energy is a perfect example of this, right? Depending on who wins, I don't know who wins. I don't know who loses, right? But there will be implications for the energy sector. The price of oil, the price of gas drives every company, in the sector. Why bet on Exxon or Chevron or the smaller ones when you can just own XLE and position yourself as, have an opinion on the sector, right? And it's not always as pure play as oil and gas would be to the energy sector, but that positioning of stock versus ETF in a very liquid instrument has been real good for us. The second way we position the product through our sales guys is more through customizing the S&P 500. So take the large cap portion of your portfolio, carve it into pieces, weight the sectors to meet your particular need, and then the flexibility of being able to sell a piece, realize a loss, maybe reallocate somewhere else as time goes on. The flexibility of not owning SPY as an example, but the pieces gives you that exposure to the index that everyone kind of the benchmark, and with greater flexibility because you own the pieces.
So somebody has S&P 500 exposure, maybe they're using a broad-based product, and they say, you know what, I don't like where we're at right now, at least for the next 6 months, I want to be out of real estate, or I want to be out of energy. I don't want to run the risk of, if Biden wins, does oil continue to rise? If Trump wins, is oil going to fall? I don't know. No one knows the answers. But could they short your products, I guess, would be another way to say, okay, I can remove an isolated piece of my core exposure by shorting one of your products.
We have normally around 400 million shares shorted at any given time.
Across the complex?
Across the complex.
Wow,
it's very liquid.
Just so everybody knows as well, in order for someone, so managers oftentimes, or people in many cases might say like, oh, don't ever talk about shorting a product. It's really not as bad as people think, because the shares have to exist in order to short them. You can't just short something unless the shares exist. So if there was insatiable demand to short energy for whatever reason, someone's going to have to create those shares to lend them out, because not everyone lends their securities, nor not everyone can lend their securities. And so sometimes sometimes short exposure can actually wind up being a windfall for the manager.
To create the lend. I mean, the one thing about ETFs that's different than a stock is that you can increase the number of shares outstanding. So the short squeeze does not really happen, right? You just create more shares. So
Right.
as a product person, I love the shorts. Short them as much as you want. You got to cover at some point, right? I want the activity. I want the trading. I want the spreads to be tight. I want people to have opinions and use our product to implement whatever they're looking to do.
Yeah, I mean, I think that we run a stock loan desk here at Mirae Asset Securities, and they do keep a close eye on ETF supply and demand. And like anything, I use the bucket analogy. It's basically, hey, if the bucket's running dry of supply, maybe it might be time to fill it up really quick by way of creation and redemption. Or creation in that case, but it works out really, really well.
No problem with shorts.
What are your best analogies for the sector spiders? When I explain it to now, it's easier when you had 9, but it's okay. There was a pizza place down by me that had, I think, 9 slices. The guy would cut the pie a certain way, and he had an odd number somehow, and
11 gets a little tight.
And so 11 gets a little skinny, but basically, we think about that a lot. We're always thinking of different analogies to talk about investment pies, if you will, and yours fits really nicely into that sort of pie chart.
You mentioned before about like opinions on leaving something out or overweighting something, right? So when you look at the S&P 500, we have 11 sectors and GICS, Global Classification System, right? So that's the standard. So they're divided by the GICS standards, right? So the 11 sectors aren't all created equal though, right? So if you look at tech is 30% of the S&P 500. Healthcare and financials kind of 12 and 10, 11, 12% of it, right? And then the smallest 3 are only like a little over 2%. So REITs, basic materials, and utilities are only just over 2% of the S&P 500. So depending on what you want to do with it, right? Do I want utility exposure to be 6% of my portfolio? You can't get that in an S&P 500 fund, but you can do that here. So the analogy is slice it up any way you like, but own the pie, right? At the end of the day, I still want to own the 500 stocks.
Order it as you want.
Any way you like it, right?
Yeah.
Any way you like it. And then we can provide that to you. And again, all 500 stocks are used in one of the sectors. It's that simple.
Yeah. Well, it keeps it easy.
Yeah.
It is, I say it's an ease of use. We've had some really interesting conversations with managers over the years, some really complex stuff. The leverage products alone were obviously a huge opportunity for you guys, I think, for a while, right? Some of the larger leverage funds are using the actual ETFs for swap exposure and things along those lines. So there's no limit to how you can use these products. And again, some of the conversations we have with managers dive into some really complex structures. Yours are not so complex that it's hard to explain. They're U.S. listed S&P 500 stocks, broken down by sector, market cap weighted, right?
It's good old fashioned ETF, the way it was created to begin with, right? The one thing I would say about the S&P 500 that people don't really notice as much is that, okay, the S&P 500 is up 10% this year, but from high to low in the last 10 years, the average from the best performing sector to the worst performing sector was 45% different. Not plus, 45 hard, okay? So one's up 30, one's down 15 on average, right? So you really can tweak this a little bit and make a significant impact to the overall portfolio. Everyone talks about tech. I mentioned energy before. Energy has been the best performing sector 2 of the last 3 years, and again, first quarter of this year is the best performing sector. It also could be the worst performing sector, right? So if you look at energy as a whole over the last 10 years, not in the last 10 years, it's either the best or the worst. Now, from a volatility perspective, maybe that's something you want to take a look at. Maybe that's something you need to be part of. So from a trader, more of a trading perspective, that's something. But the volatility in sector performance lumps up into this S&P 500 performance, and everyone thinks, oh, it's so smooth. It's not so smooth all the time, and you have the ability to kind of control that.
Yeah, tech is like that too, right?
Tech is like that too, right?
And tech now more than ever. But at least it feels that way for us.
Tech in the first, last year obviously the best performer, communication services second. Tech is underperforming in 2024. So still positive performance. Market about 7, tech's up about 4. So.
It's historically, and I had this note that tech during election years is one of the worst. I think it's second to last. Materials only being the one behind it.
And some
during
of the noise,
election
right?
years,
Some
yeah.
of the noise around tech in terms of, antitrust type stuff and who's
Yeah.
going to win, who's going, that plays into kind of the uncertainty around it.
Yeah, and there's a lot. There's a lot going on. But listen, I can't thank you enough for coming in to chat about your product suite. It's a behemoth in the ETF space, and it's going nowhere but up. I mean, this is it's great to have you here to talk about the success that you've had, and the I would say I was going to say simplicity. It's not it, but the real straight shooting.
It is.
Accuracy of your bullets, if you will,
Yeah.
of your 11 bullets. They're precision instruments, and
It's the purity of what ETFs were created to be, right?
Yep.
Low cost, total transparency, and you track the index with very low tracking error, right? We deliver exactly what we're supposed to do. If all investment products did that, it'd probably be a better place.
So
right?
back to you, the listeners. Listen, you've got your 11 ingredients, all right? You've got this sometimes disparity of 45% between the top and the worst. It's up to you to create your own active model portfolio or your own index of these products to come up with the next best investment idea using the S&P 500 and the 11 slices of that pie.
Thank you, Chris.
Thanks, Dan.
All right.
Thanks for coming.